How does increasing capital gain tax can affect you? Is it only for businesses or it's for personal income as well? In today's video, let's find out what is the new changes came in June and how it can affect you. Hello everyone, my name is Parth Soni. I'm an agent based in Waterloo region. If you do like this kind of content, please do like and subscribe. And if you want to have a chat with anything about real estate, there is a first link in the description and you can book a one-on-one call with me. Now let's understand what is the capital gain tax and how it's taxed in Canada. Now let's understand what is the capital gain. Now, capital gain is anything that you have previously invested and got some profit out of it. It could be stocks, house, business, or anything, or even this precious material as well. Let's say if you have invested some amount in that and over a period of time you get some profit out of that, that profit is considered as the capital gains. Now let's take an example and see how it will affect you. So here is an example. Initial investment is $10,000. It could be a stock or anything in which you have invested, and certain period of time you have observed a growth in that. Let's say the return on investment on that is $15,000. So the capital gain or the profit in this case will be $5,000. Now, based on the current rule or the previous rule, I would say based on the previous rule, the capital gain is taxed at 50%. So here what it is. So out of that $5,000, $2,500 would be considered as a taxable income. Not a tax, but a taxable income. Now let's say how it works. So you'll be drawing any sort of a salary. So salary plus taxable amount, that is $2,500. Depending on the bracket, you will be taxed accordingly. Now here's the new rule and how it will change the math. So based on 25th June of 2024, the capital gain is taxed at 66.7%, that is 1/3. Previously it was 50%, now it's 66.7%. Now just make sure it's not the tax increase, it's the what is taxable amount of that is increased from 50% to 66.7%. So let's take the same example. Initial investment $10,000, you got $15,000 in return. So the capital gain profit is like $5,000. Now based on 66.7%, the total taxable amount is $3,335 rather than $2,500 as per our last example. So now how it will work is like salary plus taxable amount of $3,335. And that's where you will see an increase from 50% to 66.7%. But wait, here's the thing. If you make less than $250,000 in any given year, the capital gain tax will not be 66.7%. It will be still same what you have previously paid. It's 50% only. So that means based on our previous example, you will be still liable to pay taxes on only $2,500, not on the 66.7%, which comes at $3,335. As it's less than $250,000. If anything above $250,000, that will be taxed at 66.7%. But that does not mean that only wealthy people who are making over $250,000 every year in capital gain tax will be affected. So let's find out who it will affect. So now let's say if you own a primary house in any major city in Canada, let's say Toronto or Vancouver, and if you bought a house in 1980s, 1970s, it's highly likely if you sell it right now, you will get over $250,000 as a profit. But because it's primary resident, you will not be taxed on a primary resident as a capital gain tax. But here's the thing. According to the research done by Royal LePage in 2023, 11% of Canadians does own a secondary property, that is an investment property. So if you see 11%, that is roughly about 4 million people in Canada does own a secondary property, and that could be affected with this increase in the capital gain tax. Now 4 million people is a fairly large number according to the size of the country we have. Now out of 4 million, 64% does own one property and 32% does own more than two properties. So for those people who own more than two property, this change will be very significant. Now, if you're in this scenario and let's say you bought a cottage in Muskoka in 1990s, it's highly likely you will have a capital gains in that property or that cottage over $250,000. It's highly likely that you will be get affected with the new rule. Now, there is something called lifetime capital gain tax exemptions. Now, if you are someone who is valid under that, the limit for that is $1.1 million for any businesses you are planning to sell or anything like that. And that limit is increased to $1.2 million based on the inflation and how the budget works out. Make sure you consult your accountant before doing any of those stuff and how it can affect you. Now, for most people, it may not affect this change in the rule or anything like that. But if you're someone who have a portfolio of investment property, it will definitely affect you out. If you have like second, third, or fourth property in which you are not primarily residing, then, and if you have a capital gain of $250,000, this new change will definitely affect you. So the government estimates, like based on this new increase in the rule, they are planning to incur $20 billion over a period of 5 years. Now this whole money will go into education, city planning, and all that infrastructure. And it could also go to the development of the housing, the rapid housing, accelerator housing that we are seeing across the region. Now, what do you think about this change? Let me know in the comment below.